Hi everyone, welcome to this live coverage. As usual, I'm here with Yohay Elam from Forex Crunch and Mauricio Carrillo from FXStreet. We are here to lead you to the ECB Monetary Policy session. Hello guys, how are you?
Hi Valeria, good to be here once again.
Hi Valeria, hi Yohay. Just to let people know that we are going to take the interest rate, and then we are going through Mario Draghi's speech, and we will take questions, and we will provide analysis.
Okay, so it's quite an interesting. Not only we have the ECB deciding on monetary policy, but we have also payrolls tomorrow, and we know that the market focus these days is in Europe and the US with all the political trouble, the new government in the US, the elections coming in Europe, populism in Europe, the divergences between central banks. I believe that the market has too much expectations. ECB will be soon starting some sort of tapering, right? But I'm not sure if Draghi wants that. Indeed, Germany does, but Draghi, we don't know. So I do believe that the focus today will be on that, whether Draghi decides or says something about the possibility of tapering, the discussion of tapering or not discussion of tapering, and that will lead to Yohay.
Well, yeah, I think expectations might be too high. I mean, it is a more important decision because we have new forecasts from the ECB. It's not a less important decision, it's a more important one. And inflation has been rising quite a bit. In fact, it reached the holy grail of central banking, 2%. But core inflation is lower. And regarding any tapering or on the other hand, extension of the QE program, I think it's just too early to talk about anything. They announced that the program will be extended until the end of the year, and maybe they'll provide us with a new announcement in September, or maybe they'll give us hints in August, but now in March, it's too early. Just next month, they begin implementing the reduction of QE from 80 to 60 billion. So I don't expect any announcements. Do you expect anything?
To be honest, no. I do expect some revisions on forecasts on growth particularly because, the economy is doing better. The European economy is finally doing better after years of recession, and we have seen strong numbers since late 2016. So I do believe it's possible that we have an upgrade in growth forecast. But as you said, I do agree with you that despite headline inflation has been improving and reached, in fact, the famous or infamous 2%.
Yeah.
The fact is that it's due to volatile factors, right? We have higher energy prices and fresh food backing that. And as you said, the core rating remains flat. It has been at 0.9% for 3 months in a row, if I'm not wrong. So that's telling us that inflation is not doing as good as it could sound from the headline reading, right? Besides, Draghi said in the last meeting that he dismissed the advance in inflation, saying that it was due to temporal factors. And in fact, latest data is confirming that. So the revision of inflation could be less solid, less interesting.
Yeah, more cautious.
Yeah, more cautious. That's what I'm thinking. And that's the most that I expect him for today. But also I do expect Draghi to be a bit more optimistic about the economic situation. And let's see if he had something to say about Greece, Germany, or France, or whatever it's taking his attention these days.
Yeah, I'm sure he'll be. Sorry?
Yes, he has plenty to choose from.
Yeah, plenty of answers, plenty of questions not to answer. He will choose not to answer.
Yeah.
But the ECB's only mandate is headline inflation. It's what Tricia said, the single needle in the compass. But in fact, for the last few years, unofficially, the ECB sees through lower oil prices, then sees through higher oil prices. Basically, Draghi is targeting core inflation more than anything else, like the Fed. So that's why he'll have to balance between, yes, acknowledging, as you said, that things are improving, unemployment is falling, growth is rising, headline inflation is rising, but there's still a long way to go. political uncertainty, still high unemployment. So
yeah, talking about oil, what do you think of this latest decline? It has
yeah,
plummeted $4 in a couple of hours. It's huge because it broke to fresh 2017 lows, and more relevant because it lost 50. So it lost the base of the range. In fact, it was a bit higher, around 51, 51, 55 held prices since the year started, pretty much. And here we are, 49 out of a bloom. And it's not out of a bloom, but the reaction was sort of surprising, right?
yeah. I mean, I can find quite a few reasons why oil prices should be lower, but why did it happen yesterday and today? I have no idea. Maybe cascading stop losses, maybe.
Well, yesterday the Energy Information Administration reported the 19th consecutive week of increase in oil stockpiles in the U.S. and stockpiles reach a new record high. So that could be part of the reason that pushed the price lower at the beginning. But then I agree with you that some stops got low, and then there we go, the
Yeah.
movement. But take a look at the daily. It has breaking below the 100 simple moving average. It has extended below it, pull it back, and now back down. So it's looking bad for the OPEC.
Yeah, it's back to the pre-OPEC levels, right? More or less.
Yeah, not yet, but there we are. 45 or so would be the level.
Yeah.
Guys, we have some question about euro dollar. What are our suggestion on what are the levels to sell the euro dollar?
Well, to sell it, of course, it's depending on whatever price sets, right? I'm watching a couple of levels in here. The first one is the current level, the 560 area, where the pair has been finding some support and resistance and consolidation. Take a look at your charts. If you take a look at every time the pair reaches this area, it stalls and has a bit of a struggle before taking a certain direction, either breaking or advancing. But that's my first level. The next one is 630 region, because I will change the chart to weekly. If you take a look at the weekly, 530 region just rejected price action for the past 4 weeks, right? Advances towards that level had been quickly reversed, so 630 area. I would like to see the pair accelerating through 640 to call bottom upward extension, right? And in that case, my next level comes at 700, 710, because it stands for the 38.2% retracement of post US election slide, right? And if you take a look at bigger time frames or farther away, the price has also shown there the same behavior that we are seeing in here. Not an easy level to break, some consolidation around it. And that's the most the pair can go. And I do expect selling interest around 710, right? And towards the downside, my levels are 520 and 490, which are the levels we have seen the pair bouncing from during the past 3 weeks. So I would like to see a break below 490, talk about a stronger or a steeper bearish continuation.
Yeah. I think, well, euro dollar has been once again a bit more frustrating, a bit more choppy. The levels.
You think?
We did have this jump, I think it was on Friday, which was a bit above average in terms of volatility, but not that extreme. Anyway, I'm looking at 106.40, 106.80 to the top side, to the downside 105.20, and 104.90, which was the low last week.
Yeah.
I expect, regarding the ECB, I think that Draghi would still like to have a slightly weaker euro. This will help export growth, and will help make the rise in inflation more sustainable, maybe push core inflation a bit higher. But again, you will have to acknowledge that things have improved, and he's not going to introduce new stimulus, at least not now. So I think that any negative effect regarding the question about selling the euro, if we do have a sell-off of the euro following Draghi managed to do it last time, I don't think it'll be long-lasting. I think there are other factors, as Valeria mentioned, non-farm payrolls, elections in France, you name it, that will then push the euro up or down once again after Draghi. So
yeah, 710 is my top, ultra top in the case of a super hawkish Draghi. I believe that if we reach that level, then it will be all the way down from there. But I do agree with you that any kind of upward move in here will be temporal.
Yeah, I think 107.10 was a low level seen last year or in 2000. It rings a bell, this level. Ah, yeah, here we are at December 2015.
In between 700 and 720 is quite a messy area where we have plenty of low, highs, Fibonacci, and a lot of other things that tell me that that's a tough one to break.
Yeah. So,
what do you think about the pound, Yohay? It has been falling down, falling and falling. And in fact, it's reversing all of the gains triggered by Theresa May early January when she announced the hard Brexit, right?
Yeah, that was the low point for the pair when she talked about hard Brexit. Since then, okay, everything was priced in. Now we're falling, I think, once again on fears that maybe in 2017, the economy is beginning to slow. Maybe the government doesn't really know what it's doing regarding Brexit. But I think, like with oil prices, I can't put my finger on exactly one event that pushed it lower. So what do you think is causing this fall?
I believe that the setbacks that Theresa May is getting from the House of Lords, it's helping the pair change course, right? And I do agree with you that fundamentals are not backing a strong pound ever since, I don't know, October, November, meaning we have a spike of positive figures right after the Brexit, right? We have one or two bad numbers, but then everything was, whoa, manufacturing growing, services growing, construction growing. So that pushed the pair higher, and all of a sudden we are back to poor readings, to disappointing numbers, and to slower growth. We have discussed this plenty of times during the past few months. The cheaper pound couldn't be a good news for local manufacturers. Could be in the first time, but their costs will rise, and that will end up affecting consumption, right? Anyway, we are at the time. Remember, guys, we have a bit of delay, but here we go with
no change rate. As expected. ECB leaves rates unchanged.
No change in rates, no change in nothing.
I don't see anything. I don't see a reaction.
So barely.
Euro dollar is falling. Why is that?
Yeah, 10 pips. Sorry, I have to move money.
Yeah.
Yeah, interest rates and QE on hold. So now it's wait and see for our friend Mario Draghi.
Draghi show. Yeah, no change. Yeah, regarding what you said about the weaker pound, it helps export growth manufacturing just a bit, but it's beginning to take a toll on UK consumers. We've seen the two latest retail sales report were very disappointing. That was December and January, and for February we don't have the official retail sales numbers, but we have the BRC number, the British Retail Consortium figures, and they also show a year-over-year drop. And another report shows that the British are buying more essentials, more food, for example, but less non-essentials. So I think eventually this will hurt the economy, and that's another reason that weighs on the pound, one of the negatives.
And the dollar Japanese yen, it's there waiting, waiting for something, not able to set clear direction. I believe that much of what market will decide will depend on tomorrow's payrolls, right? But I still believe that the Japanese yen is the strongest currency across the board, besides the dollar, of course, and that the pound is the weakest, right? So
Yeah.
whatever the outcome tomorrow is, trade accordingly, right? If the news are dollar positive, then probably selling the pound will be the best choice. And if the news are dollar negative, then selling the dollar Japanese yen will be the alternative, right? So
Yeah, great
that's
point.
one to advance.
Valeria, what is going on with the New Zealand dollar? Like a free
What?
fall with the New Zealand dollar. You know, it's like a free fall for the last 2 weeks.
Honestly, I don't know. I don't follow much the pair, but I do see it correlating with the Aussie, right? It's pretty much replicating the behavior of the Australian dollar. Commodity related currencies are under pressure because of the sharp retracement we are seeing in gold and crude. And on disappointing Chinese data, remember all those economies depend on how much China imports or buys from them. And the fact is that lower inflation, deficit in their trade balance for the first time in 3 years in China, I mean, right? It's waiting on commodity related currencies.
Yeah, I'm following the Kiwi a bit more closely. There are two other reasons that pushed the Kiwi lower. First of all, the RBNZ decision about 2 weeks ago, they were relatively dovish. They did not acknowledge the fact that the economy is doing quite well. They sort of saw the glass half empty, not expected to cut rates anytime soon, but relatively dovish. And another thing is milk prices. After the GDT price index released every 2 weeks had a winning streak towards the end of 2016 and early 2017. But in the past two auctions, in the past month, it fell twice. First time about 3.2, if I'm not mistaken. Second time this week, 6.3%. So two big drops, especially this week. So it all snowballs into an avalanche.
Do you see the pair going below 68 or not? I'm watching some buying some there, but what do you think?
A lot depends. Now the focus moves away from New Zealand, moves away from everything to the Fed, and what moves the Fed is the next big thing is the non-farm payrolls. So if we have great wage numbers, yeah, for me the level I'm watching here is 68.60, which was the low. Exactly. So that's the sort of critical line. If we fall below that, we're back to levels last seen almost 9 months ago, back in June. So this is, for me, a very strong line, and resistance is at 69.50 at the moment, weaker resistance. So, but I think the ball now is at the court of the Fed, the court of the jobs report released tomorrow, very late in the month, March 10th.
Indeed.
Yeah, that's right. Okay, guys, what do you think if we make an approach on gold? Valeria?
Yeah, give me a second. I want to bring my charts back here. We have been talking for a couple of years about gold trading in relation with Fed's decisions and commodity rising when chances of a rate hike were low, and gold plummeting when chances of a rate hike were high, right? That correlation was sort of interrupted at the beginning of this year, right? When the commodity began to rise. But if you take a look at large time frames, you will notice that this rally stalled around the 200 simple moving average in the daily, and also the 61.8% retracement of the post-US election decline, right? So it was a huge resistance the commodity faced at 1260. And now I believe that we have entered in a bearish market. It has corrected pretty much half of that latest advance, and it's challenging the 1200 area. It's a major support. We have uh, a quite strong supporting year in between 1198 and 1208. If you look at your charts, you will notice the commodity is still there a lot, but for most, I'd see it extending its decline. But of course, and yet again, sorry for saying this, it will depend on the Fed, right? And tomorrow's payrolls and the Fed next week will decide whether the commodity will continue falling and or not, of course. And if we have a rate hike and we have a super strong payroll, the commodity can go down to 1150, 1100, 1150, and I mean, as a probable bearish target. There's one thing I would like to say about the Fed, right? Which, with the comments from Yolan last week, and the March hike has been pretty much confirmed, right? And if she said that they will rise rates, if that comply with their objectives, meaning strong report, firm inflation continue to rising or going as they are, they will rise rates, right? So tomorrow, a positive non-farm payroll headline and wage numbers will probably support the case further for rate hike. But don't forget that the market has already priced in above a 90% chance of a rate hike next week, right? So what actually will back the dollar is how many more rate hikes we are going to have this year, because the market still believes that we are going to see just two, right? If the Fed somehow confirms that we are going to see three, things will going to turn really dollar bullish everywhere, right? But the Fed needs to confirm, or sort of, in their mixed bail language, that we are going to get 3 rate hikes this year. That will be a mid long-term dollar boost.
Yeah. So as you said, Yellen put the bar at a very low level. I think the key for tomorrow is wage growth, because wage growth represents the combination of employment and, well, inflation. If the market reached full employment, if the job market reached full employment, then now wages should rise because employers are competing for employees. I think that if we get year over year 2.3%, that would be really bad news. It'll be a drop, it'll be a setback going backwards. Maybe it'll cast doubts about a rate hike, but I think we're more likely to see something like 2.8%, and I think also 2.4 will be more than enough. I think that if we'll get over 2.8, if we'll get something like 2.9 or higher, then we'll, as you said, markets will begin thinking of pricing in maybe speculation about 4 rate hikes this year in each big meeting, March, June, September, and December. Of course, they can change their mind many times on the way. And so for me, these are the levels I see: 2.4 to 2.8, 3 hikes in 2017, basically priced in. At the moment, the dollar jumps maybe a bit up and down, maybe ends a bit higher, but it will not be a huge surprise. And if it reaches 3% even, that'll be great news for the dollar, and 2.3 or lower, bad news.
I'm not sure if the market is convinced yet about the 3, but well, I have to review. And it's there. It's the number of hikes what we will be watching for after and if we have a March hike, right?
Yeah, you think they'll raise rates only 2 times in March and then maybe in September, or?
I know that the market is like a 90%, as you say before, guys, that the interest rate is like a 90% priced in. But what if they don't?
That will be a quite interesting Wednesday we are going to have next week. If they don't, well, I will be shorting the dollar Japanese yen as quickly as I can. Because, as I said, I do believe that the Japanese yen is one of the strongest currencies these days. I'm not so confident about euro or pound gains, right? But of course, in the short term, meaning maybe 24, 48 hours, the dollar will be under strong selling pressure across the board if they don't, right? But if they make all this noise for so many weeks with every single Fed office speaking out a March hike, and they don't deliver, oh well, that would
Yeah,
be
that's
huge.
right. That's right. But what, in your opinion, what make the Fed to down high rates?
A really lousy non-farm payroll report tomorrow with wage plummeting as Yohay mentioned. Wage are extremely relevant because poor wage mean poor inflation. So that could be one reason. The other is, I don't know, US President Donald Trump loves to open his mouth at the less convenient moment and say the less convenient things, right? So we can get any kind of surprises from him from here until Wednesday in any moment, Sunday, Saturday, morning, night.
Yeah.
That's the other factor that we could consider it's the unknown factor that could affect it.
And then the last time the President Donald Trump, make kind of mistake saying that about the wiretapping about Obama. He could be very dangerous for him. The White House has a complaint against, the staff, his advisors, has a complaint against him because this is more darker waters than it appears to be. It could be finally an impeachment on that. Oh well,
It's a box of surprises. It's a box of surprises, which it's interesting because at least it triggers volatility. But hey, don't forget your stop loss. Never ever.
The gift that keeps on giving, yeah.
Yeah. In the meantime, oil is breaking lower below 49, guys.
Oh yeah.
Wow. Yeah. Sorry?
No, I was thinking nothing can stop me now.
Yeah. Yeah.
Look at
So
the
we're
pound,
already.
and the pound too. The pound is breaking up.
Yeah, it's advancing a bit. It's just some position adjustment ahead of the event. I won't run behind these movements. It's so risky.
Yeah, we're here to cover the ECB event that should move the euro, but in fact, the euro is standing still, and there are other interesting things in markets.
Yeah. Yeah, worth mention also that the reaction would, of course, be strong in the euro. Because the goal would probably replicate euro's behavior, and the rest of the currencies may see more limited reactions to the news, unless it's something huge.
Yeah. Besides Mario Draghi, we have jobless claims, export and import price index.
In the US, yes.
Yeah, and also data in Canada, new housing price index and the capacity utilization. Okay.
Yeah, Canadian dollar naturally falling together with oil prices. Dollar CAD above 135.
Yeah.
Regarding oil, I would say we're already a bit more than 2 months into the implementation of the OPEC non-OPEC deal. Yeah. There's a high level of compliance from OPEC, but it's mostly Saudi Arabia, and non-OPEC countries, it's a bit lagging behind. And U.S. production continues rising past the 9 million barrels per day threshold, and inventories of at least crude oil continue rising. Gasoline distillates a bit less. So there are reasons to see oil prices falling, but this is quite a big collapse in the past less than 24 hours.
Yeah, well, as longer it lasts a certain range, as interesting will be the breakout later. And the commodity has been confined to a 4 bucks range for over 5 or 6 weeks or more, a couple of months, in fact.
Yeah.
Right? So there we go.
Hopefully that'll come also with the euro.
Okay, almost 15 weeks trading in nowhere land, and all of a sudden breaking lower. So that is making it interesting. And the euro keeps struggling around that 560.50 region. And the pound actually needs to regain 22 to look less bearish, but not turn bullish. In fact, the 2260 region seems for me the resistance level that we need to regain to see an upward extension here seems quite unlikely for today. But well,
yeah.
Guys, just remember that if you have any questions, we are happy to help you with the answer or with kind of analysis that you want.
Yeah. Also, moving the euro a bit, or as we said, euro is not moving enough, but the French elections, they're coming up. The first round is on April 23rd, second round on May 7th. In recent days, we've seen opinion polls move in favor of the centrist former socialist Emmanuel Macron and against extreme right Marine Le Pen, and also against center-right Francois Fillon because of his scandals. The theories should be market positive to see extreme right Marine Le Pen, which wants a referendum on Frexit, losing a bit of ground. On the other hand, markets wanted Francois Fillon to be replaced by another center-right candidate, Alain Juppé, and he announced on Monday that he will not run. So that was a bit of a disappointment. But markets are hoping for a victory of the young Emmanuel Macron, centrist.
Valeria, there is a question for you about the gold. If you can share your thoughts about gold again.
Yeah. Tell me.
Yeah, go ahead. Is any comment on gold, the levels to watch, what's going on there?
As I said, that
forecast.
Yeah, as I said, that 1198, 1208, it has been a pretty messy area in the past, over this past couple of months. So that's quite a supportable area for me. And I would like to see a 1195 or lower to confirm a bearish continuation in the commodity. That, depending on payrolls and Fed, could extend right first towards these zones are in the 1180 region, but further lower down to 1115, 1150, sorry, during the upcoming week, right? And I don't see that hopes of a rate hike are keeping the commodity in the negative side. So actually not expecting much of an upward potential. This low we had here around 1216, 12815 is the level I will be watching. As a recovery above it will take some of the bearish pressure and maybe anticipate an upward corrective move from this sharp slide, but honestly not seeing much of an upward potential, of course, unless we have wild surprises today from the ECB and a terrible payroll and no rate hikes and all the change in the scenario we are waiting for, right? But for the most, I believe that it's bearish in here today.
Yeah, I find it hard to see a terrible payrolls, and there is even a chance that the Federal Reserve officials already know the result. It's published very late in the month, March 10th this time. So
Yeah,
I
it seems
think.
quite unlikely, but well, we don't know. We are not Fed.
We don't know. We don't know.
Yeah, we are not the Fed officials. Hope we,
Not yet. No.
right? Okay, long waiting. 23 minutes to go for
Yeah.
Draghi. Hope he does not disappoint us.
Yeah. Maybe talk about that just a bit.
Well, there is a question here. Sakib asks if are you expecting Mario Draghi to say something positive about the euro?
I do believe he
No.
was positive
No.
about the economy, but not about the euro. Yeah.
Or do you think he will continue his dovish tone and lower GDP outcome for 2017?
I would say more worried about inflation, that it's still not sustainable enough, that more stimulus is needed, more accommodative policy is needed. Let's talk about growth. You might be optimistic about growth.
Okay, so do you expect a dovish stance on Draghi as he wants a Europe a little more lower, right?
Yeah, but not, he's not going to paint everything in black, saying it's a terrible situation, because the situation is not terrible, but he'll stress that more accommodation is needed. My sort of baseline scenario is that he will be relatively cautious, dovish. That'll hurt the euro but for a relatively short time, and then other events will take over, positive or negative.
I can agree with you. He said that Draghi will probably try to talk it down, whatever it takes. Okay.
Yeah, regarding growth picked up to 0.4% in Q4. The unemployment rate is 9.6, so these things are an improvement. Business confidence is higher, consumer confidence is higher. But on the other hand, core inflation remains low, and there's a lot of way to go.
Okay, so
Any questions about tapering? You'll say probably too soon.
Yeah.
Too soon. So, but many people are expecting for tapering talks or tapering opinion, and if he says too soon, and nothing else, many people will get disappointed.
If he says, yeah, in the previous meeting, I do believe he said that we didn't even discuss that or something like that, right? So if he says that again, it will probably offset any positive comment he makes and put the euro under pressure.
Okay, and on the downside, Valeria, what are the levels to watch?
In euro?
Yeah.
520 and 490, where there has been bottoming over the past 3-4 weeks. Those are my first immediate supports, right? And if we break 490, I do expect that it will blow a large amount of stops, and therefore we can go down to 420, 440 region. Not that much because of payrolls coming tomorrow, but that's what I'm thinking.
Okay, well, we have a comment here, I think, for you both guys. This Sakib is saying that on the other side, he has been thinking about the dollar. With Trump wanting to all American products to be produced in USA, with higher US dollar, the cost of any item produced in the US will approximately go 3 times the value up. So then to sell them. So the only option the US will be left with will be devaluate the US dollar. Any opinion of that?
Oh, Lord. I do believe that Donald Trump is not sure whether he needs a weaker or a stronger dollar, right? He has made his case for protectionism as described in the comment you read, but he also said he wants to make the greenback more competitive, right, with China products and so on. So I'm not sure what he really wants, if a stronger or weaker. And I do believe he doesn't know what he really needs.
Well, there was a gossip that tells that Trump was calling somebody, one of his advisors.
In the morning, yes,
Yeah.
It was Michael Flynn, the former national security advisor, and he told him, Mr. President, it's not my field of expertise, ask an economist. So
yeah, an advisor asking whether he wants a weaker or stronger. I don't know. You know, it's I wish I know that much of economy to be sure of what to do in this scenario, right? Being in Trump hunts, I mean, right? But to be honest, yeah, I'm not sure how things will go on and if he could deliver all the pledge he made so far, right? But well, let's see.
There is another contradiction in Trump administration, in the Trump policies. He states that the debt has to go down, but on the other side, he make a case on infrastructure. He wants to invest a lot of money there, so you cannot spend a lot of money cutting at the same time the debt. You know, it's complicated.
Oh.
Yeah, but in the case of the dollar, that's a problem too, because if you get a stronger dollar, you will not sell that product too fast. But on the other side, if you get the dollar down, your profits will go, down too. So I don't know. What is your opinion on that, Yohay? I mean, what is the way to do?
Well, I think the best thing to do at the moment is just leave the dollar to the influence from the Fed and not intervene. One of his advisors, Peter Navarro, wrote a book called Death by China. He thinks China, Japan, Germany are all devaluing their currencies against the dollar. I would say that also the US sort of participated in the currency war with the Fed's QE program. Anyway, other economists in his team, like Treasury Secretary Steve Mnuchin, businessman, he's sort of more mainstream U.S. politician, or so. I really don't know. Again, as Valeria said, I think it's a bit hard to analyze what Trump wants. At least on the dollar was something he doesn't really know anything about. So.
Okay, Valeria, just turning back to Forex, Mohammed, he is joining the conversation and he didn't get your goal explanation. Do you mind to repeat that, your forecast on gold and your levels?
Yeah, mostly what I have said about gold, it's of course whatever comes next depends much more on the Fed and payrolls tomorrow than whatever happens today with the ECB. It's mostly bearish, and it has a quite strong messy or support area in between 1198 and 1208 where we're extending right now. So I would like to see that this area clearer before going short, right? In that case, 1180 seems the first probable bearish target. And then 1150, right? That seems likely. Moreover, if we have a rate hike. And to the upside, I would say that this lows around 1216 or so are the resistance to watch these days, because above that level we can correct farther higher, but not much more. Overall, I do expect a bearish extension in gold during the upcoming days.
Okay, thank you. Val. So we are 15 minutes to go before Mario Draghi. Yohay, just like a recap, what we can expect today from Draghi?
We can expect no changes in policy. The ECB recently changed its policy back, in December. So QE is falling from 80 billion per month to 60 billion in April and running through the end of the year. The time for new announcements, either tapering it down, reducing it, ending it, or the other way, extending it, even increasing it, is not now, probably closer to August, September. So I don't expect any announcements. The big question is the tone. Will he be more optimistic on rising inflation, at least core inflation, lower unemployment, but and higher growth, or unemployment is still high, growth still needs to grow legs of its own, is not sustainable enough. Core inflation is low, 0.9. I think he'll have a fine balancing act. I think his desire is to keep the euro a bit lower to help export growth and to help sustain the rise in inflation. But my baseline scenario is that without talk about tapering, with seeing also the negative sides of the Eurozone economy, he will hit the euro like he did last time. On the other hand, it will not last too long. We have then non-farm payrolls tomorrow, French elections, and we'll refocus on these things in a relatively short while after Draghi. Now the focus is Draghi, but I don't think it'll last too long.
Your opinion, Valeria, what are the levels to watch here? What are the prayers to watch, to focus, going into Draghi, yes?
Yeah, of course, first of all, the euro, right? Above 600, I don't see much to the upside unless we overcome these highs in the 630 region, as the pair has retreated from that level multiple times over the past 3 or 4 weeks. So 630, it stops for me in the case of a really a positive surprise, which we are not expecting. If somehow the pair breaks above it on an ultra super positive surprise, then 710. And to the downside, 520 and 490 are the levels, as we mentioned, because it's where the pair has been bottoming this also past 3 or 4 weeks.
Thank you, Valeria. And now, Sakib from the YouTube chat, he's saying something interesting. He thinks that the trading is not technical anymore. It's all about fundamentals right now. What do you think about that?
It's good question, but no. Let's see. When fundamentals go one way and technicals,
fundamentals and political, yeah.
Yeah, I mean political. When fundamentals go one way and technical go the other, I follow technicals for the most, with a smaller positions. When both are aligned, I go with full mode, right? That's my policy, and that's pretty much what I'm doing. But technicals are following fundamental states. I mean, there are no bullish signs in the euro, right? And the pair is 200 pips away from a multi-year low. So here we are. The pound is also weak, and technicals are showing the same. So technicals follow fundamentals. Of course, there are big events such as central bank payrolls and stuff like that can actually interrupt or break any kind of technical analysis. But the rest of the time, it's unlikely that macroeconomic figures can change all the technical scenario. That's something that's for central banks and payrolls. And even so, payrolls had not been doing that for over a year or more, because jobs gains were steady and within Fed's target, right? So it has been a bit of a disappointment, payrolls lately.
And what are your take on that, Yohay?
Well, I don't think many things have changed. Perhaps within fundamentals, politics now matter more than in the past, and economic indicators matter a bit less. But my approach remains the same. Fundamentals are good for the bigger moves, for the direction of markets. and technical analysis is useful for entry and exit points, stop loss orders, things like that. So I think both are useful, and I don't think markets have radically changed in that sense in the past months or past year or so.
Okay, thank you. Well, Sakib is just asking you, well, telling you, Valeria, that he didn't mean to underpin your technical.
No, it's
He always read your articles and the explanation, and you are his favorite.
Okay, thank you. No, I didn't understand it wrong. Don't worry.
Okay.
Just trying to explain how I follow the market.
It's
way,
complicated.
Not everyone's way. It's just my way.
Yeah, it's complicated. It's we are in of course we are in a political turmoil times, but also technical. The technicals are always the technical. They show us the levels to focus on, the trends and the zones to buy or to sell. We can follow the fundamentals, but we cannot go up in front of a resistance. Resistance, or go down in front of support.
Yeah, what I would like to add is like we all have different approaches to the market, and that's not mean that one is more valid than the other one, right? Different approaches between a mix of technical and fundamental are okay, and well, everyone needs to find what fits best for themselves.
Yeah, what works best. That's the best thing to go for you. Yeah.
Yeah. Okay, guys, we are 6 minutes to go, Draghi. Just remember that we will have Mario Draghi here live speaking to us, and we will make comments on what he says, and of course the awesome, the impressive opinion of Valeria Bednarik and Yohay Elam, the only one. Okay, 5 minutes to go.
Yeah. Finally, hope he delivers something interesting.
Yeah.
Interesting. Sorry.
In the meantime, oil prices, which tried to steal the show from Draghi and from the NFP this week, they're bouncing back up, 49.50.
Yeah.
So if you're looking for lots of action, oily oil, yeah.
Yeah.
Hopefully Draghi will take over soon and rock markets.
Yeah. The Japanese yen was again rejected by 15. I didn't notice that. I was so focused on the euro today.
Yeah, we really want to see euro dollar moving, right? So
yeah.
Yohay, there is a question for you here. Is there, from this Aresta, is there any possibility that market is doing by the rumor sell the facts regarding that rate hike? I suppose he's talking about the Federal Reserve.
Yeah, of course there's a chance. I think it's mostly priced in, a rate hike by the Fed. A lot depends on what's next now. So assuming we have an okay NFP and expectations remain the same, Fed is going to raise rates, as they told us, on March 15th. And I think that it's one of the scenarios we discussed earlier. If Yellen is a bit more cautious, if the dot plot shows 2 rate hikes moving forward, uncertainty about politics, uncertainty about China, Europe, whatever, then there's a chance that the dollar will fall while the Fed raises rates. So if they're all neutral, I mean, if they're okay, we're going to raise rates 3 times, repeating the same messages, then I think dollar has some chance to move a bit higher, but it's mostly priced in. So it's hard to see big movements in that case, in that scenario, because it's mostly priced in. But we could see a sell effect. Of course, there's a chance they'll upgrade forecast for 4 rate hikes, a bit more unlikely given the uncertainty, but who knows? And Yellen will sound very upbeat, and we'll have a hawkish hike, and that means, like in December, that means even though the rate hike was priced in, we're now expecting even more rate hikes, and the dollar has more room to rise. I think for me, the baseline scenario is we raised rates now. The opportunity was stable financial markets. Forecast remains the same. Data dependent, wait and see. And in this case, there is a chance of buy the rumor, sell the fact. I'm not 100% sure, but it is a possibility. Yeah.
Thank you. Your opinion on that, Valeria?
As I said earlier, I do believe that over 90% of a rate hike is already priced in the greenback. So yeah, by the rumors, sell the fact movement could be seen. But as you had said, it will depend on what's next, right? We are always looking one step forward. So if the Fed sounds hawkish over the future, upgrades growth and inflation forecast, announces more than rate hikes in line, or maybe one from June, July, as Yohay was saying, then, well, the dollar will get a boost indeed. What's keeping the dollar from really running? It's, of course, what we have been talking about Donald Trump and the uncertainty he generates, right? And that's a huge factor that we cannot ignore. But if we just look at economic and monetary policies, well, there are no doubts that the Fed is in advantage against all of the other central banks, right? So overall, dollar will remain strong unless the Fed says, okay, we hike now and don't ask us when we are going to move next because it's not the right time. If the Fed said something like that, then, well, yeah, another setback for the greenback.
Yeah.
But of course, what we are talking here are just possibilities, right? Not facts.
Yeah, and a lot also depends on the jobs report tomorrow, wages for me in particular.
Okay. Draghi.
Yeah. So it's about to begin soon, right?
Yeah.
Yeah, like in 30 seconds.
The governing council. We also get US jobless claims.
Yeah, we come.
So we're at 105.55, just before the ECB begins talking. Yeah, Draghi begins talking, sorry.
Yeah.
Jobless claims disappoint with 243,000. A small disappointment, basically in the same range.
Yeah. The 4-week average anyway was good. Not expected.
Yeah, last week it was better than expected, 223 before revisions.
Okay. It's late.
Okay, I'm waiting for Super Mario.
Yeah.
Yeah.
It's time. We'll probably hear all the jokes about Italian running the central bank, running late. In any case, euro dollar is very, very stable.
Yeah.
Hopefully not for long.
Okay, he's coming.
Yeah.
Hey. Super Mario, Draghi Drag, the Draghi Show. All the usual headlines are waiting.
And here we go. Good morning, ladies and gentlemen. Does not look good.
What's the color of his tie? Blue.
Blue.
What does it mean? Nothing, probably. Okay.
He has bags, big ones below his eyes, and he's not smiling big. So.
Okay.
See how serious he is?
Yeah. Looks a bit depressed.
Yeah.
Ladies and gentlemen, the Vice President and I are very pleased to welcome you to our press conference. We'll now report on the outcome of today's meeting of the Governing Council. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. We continue to expect them to remain at present or lower levels for an extended period of time, and well past the horizon of our net asset purchases. Regarding non-standard monetary policy measures, we confirm that we will continue to make purchases under the asset purchase program at the current monthly pace of 80 billion euros until the end of this month, and that from April 2017, our net asset purchases are intended to continue at monthly pace of 60 billion euros until the end of December 2017, or beyond if necessary, and in any case until the Governing Council sees a sustained adjustment in the path of inflation consistent with its inflation aim. The net purchases will be made alongside reinvestments of the principal payments from maturing securities purchased under the APP. Our monetary measures, our monetary policy measures have continued to preserve the very favorable financing conditions that are necessary to secure a sustained convergence of inflation rates towards level below but close to 2% over the medium term. Their ongoing pass-through to the borrowing conditions for firms and households benefits credit creation and supports the steadily firming recovery of the euro area economy. Sentiment indicators suggest that the cyclical recovery may be gaining momentum. Headline inflation has again increased, largely on account of rising energy and food price inflation. However, underlying inflation pressures continue to remain subdued. The Governing Council will continue to look through changes in HICP inflation if judged to be transient and to have no implication for the medium-term outlook for price stability. A very substantial degree of monetary accommodation is still needed for underlying inflation pressures to build up and support headline inflation in the medium term.
More support needed.
If the outlook becomes less favorable, or if financial conditions become inconsistent with further progress towards a sustained adjustment in the path of inflation, We stand ready to increase our asset purchase program in terms of size and or duration. Let me now explain our assessment in greater detail, starting with the economic analysis. Euro area real GDP increased by 0.4% quarter on quarter in the fourth quarter of 2016, following a similar pace of growth in the third quarter. Incoming data, notably survey results, increase our confidence that the ongoing economic expansion will continue to firm and broaden. The pass-through of our monetary policy measures is supporting domestic demand and facilitates the ongoing deleveraging process. The recovery in investment continues to be promoted by very favorable financing conditions and improvements in corporate profitability. Moreover, rising employment, which is also benefiting from past structural reforms, is having a positive impact on households' real disposable income, thereby providing support for private consumption. Also, there are signs of somewhat stronger global recovery and increasing global trade. However, economic growth in the euro area is expected to be dampened by a sluggish pace of implementation of structural reforms and remaining balance sheet adjustment needs in a number of sectors. This assessment is broadly reflected in the March 2017 ECB staff macroeconomic projections for the euro area, which see annual real GDP increasing by 1.8% in 2017, by 1.7% in 2018, and by 1.6% in 2019. Compared with the December 2016 Eurosystem staff macroeconomic projections, the outlook for real GDP growth has been revised upwards slightly in 2017 and 2018. The risks surrounding the euro area growth outlook have become less pronounced, but remain tilted to the downside and relate predominantly to global factors. According to Eurostat's flash estimate, euro area annual HICP inflation increased further to 2% in February, up from 1.8% in January 2017 and 1.1% in December 2016. This reflected mainly a strong increase in annual energy and unprocessed food price inflation, with no signs yet of a convincing upward trend in underlying inflation. Headline inflation is likely to remain at levels close to 2% in the coming months, largely reflecting movements in the annual rate of change of energy prices. Measures of underlying inflation, however, have remained low and are expected to rise only gradually over the medium term, supported by our monetary policy measures, the expected continuing economic recovery, and the corresponding gradual absorption of slack. This pattern is also reflected in the March 2017 ECB staff macroeconomic projections for the euro area, which foresee annual HICP inflation at 1.7% in 2017, 1.6% in 2018, and 1.7% in 2019. By comparison with the December 2016 Eurosystem staff macroeconomic projections, the outlook for headline HICP inflation has been revised upwards significantly for 2017 and slightly for 2018, while remaining unchanged for 2019. the staff projections are conditional on the full implementation of all our policy measures. Turning to the monetary analysis, broad money, M3, continues to expand at a robust pace, with an annual rate of growth of 4.9% in January 2017, after 5% in December 2016. As in previous months, annual growth in M3 was mainly supported by its most liquid components, with a narrow monetary aggregate M1 expanding at an annual rate of 8.4 in January this year, after 8.8% in December 2016. Loan dynamics followed the path of gradual recovery observed since the beginning of 2014. The annual growth rate of loans to non-financial corporations was 2.3% in January 2017, as in the previous month. The annual growth rate of loans to households was 2.2% in January 2017, after 2% in December 2016. Although developments in bank credit continue to reflect the lagged relationship with the business cycle, credit risk, and the ongoing adjustment of financial and non-financial sector balance sheets, the monetary policy measures put in place since June 2014 are significantly supporting borrowing conditions for firms and households, and thereby credit flows across the euro area. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed the need for a continued, very substantial degree of monetary accommodation to secure a sustained return of inflation rates towards levels that are below but close to 2% without undue delay. In order to reap the full benefits from our monetary policy measures, other policy areas must contribute much more decisively to strengthening economic growth. The implementation of structural reforms needs to be substantially stepped up to increase resilience, reduce structural unemployment, and boost potential output growth. Against the background of overall limited implementation of country-specific recommendations in 2016, greater reform effort is necessary in all euro area countries in 2017. Regarding fiscal policies, all countries should intensify efforts towards achieving a more growth-friendly composition of public finances. A full and consistent implementation of the Stability and Growth Pact and of the macroeconomic imbalances procedure over time and across countries remains crucial to ensure confidence in the EU's governance framework. We are now at your disposal for questions.
Mr. Speziale?
Alessandro Speciale, Bloomberg News. Mr. President, in January, you outlined 4 criteria for describe the sustained adjustment path of inflation. Could you give us a progress report, how far you feel you are in fulfilling each one of those? And there has also been a debate about introducing a small change to the forward guidance, which is removing a clause that says that you are still ready to lower rates if needed. And if I'm not mistaken, this clause is still in place. So could you explain to us why and if there has been a debate on this passage? Thank you.
Thank you. Well, let me give you the substance of the discussion we had at this Governing Council. And in so doing, I'll also answer your points. The first, it's actually been built, if one wants to summarize, it's been built on 3 blocks. The first one is the acknowledgement of success. Namely, our monetary policy has been successful. And let me give you just a few numbers of why we say that and how we measure this success. Since 2015, real GDP growth has been steady at between 0.3 and 0.6% quarter on quarter. The Economic Sentiment Index in February this year is the highest since 2011. The PMI Composite Output Index, this again February 2017, is the highest since April 2011. The unemployment rate in January was 9.6. It's the lowest since May 2009. Employment-wise, well, I said last time that in the last 3 years, 4 million jobs being created. Now, in fact, it's more than 4 million jobs because there's been a revision in the number of employment figures in Germany of recent. So it's even more than 4 million. And by the way, incidentally, in just giving you these numbers about employment, let me add that those who have doubts about the equity of our asset purchase program are being answered, because the most equitable measure of all is to create employment and to decrease unemployment. The recovery broadened further in the last quarter last year across sectors and across countries. And the interesting thing, which is continuing, I think I remarked about that last time, is that the dispersion of value-added growth across countries reached an all-time low. In other words, countries seem to grow more together. An all-time low since 1997. If we move to inflation, I would say that risks of deflation have largely disappeared. Market-based inflation expectations have increased noticeably. Also, those are longer-term horizons, even though they are still below the level that is considered to be adequate for pronouncing victory on the inflation front. The financing conditions and credit demand have continued to improve. Lending rates for households and companies have declined significantly, by more than our key interest rates. The cross-country heterogeneity, you remember the time when we had fragmentation, we had countries where our lower interest rates were not passed to or through lower lending rates, and now this heterogeneity is materially decreased. For example, loan rates in Italy and Spain have declined more than in Germany and France. The borrowing conditions for SMEs have improved, and the firm's demand for loans has increased considerably. And also very important, the NFC, the non-financial companies' leverage has gone down quite significantly. Finally, let me give you a final estimate of the impact of our monetary policy measures in the 3 years between 2016 and 2019. The accumulated impact of our policy measures is 1.7% on inflation, additional, being created by our policy measures, and 1.7% on growth. So that's basically the assessment that inspired the interventions of the Governing Council member, namely acknowledge the success of our policy. The second block was the one that you just heard me saying in the introductory statement, namely the appropriateness of the present monetary policy stance upon which these projections are based. So, based on current information, the monetary policy stance that I've just read in the introductory statement is considered appropriate by the Governing Council. And the third block was a discussion about risks, about the economic situation, how it has evolved. And again, there was a general recognition that the balance of risks has improved, certainly as far as growth is concerned. So, following from this, it's quite clear that the assessment of certain scenarios that were considered very likely before is now telling us that these scenarios are going to become less likely. And that had some consequences in our language, namely, there was a sentence which has been removed from my introductory statement that used to say, if warranted to achieve its objective, the Governing Council will act by using all the instruments available within its mandate. You remember from the previous introductory statement, that's being removed. That's being removed because basically to signal that there is no longer that sense of urgency in taking further actions while maintaining the accommodative monetary policy stance, including the forward guidance. But that urgency that was prompted by the risks of deflation isn't there. That was the judgment, the assessment of the Governing Council. The second issue on which I would like to draw your attention is that, as you know, the last TLTRO, the TLTRO's list is going to expire, and there was no discussion about having another TLTRO, not at all. Then we had not an intense, but just a cursory discussion about whether to remove the word lower from the forward guidance. Now, let me also, before I get to that, let me tell you what I said in this press conference in March 2016.
$1 is now on the rise.
Said, from today's perspective, and taking into account the support of our measures to growth and inflation, we don't anticipate that it will be necessary to reduce rates further. Of course, new facts can change the situation and the outlook. Since then, we frankly never discussed. So we had an exchange on that. Now I'm saying this because just to emphasize that it's not a dramatic choice whether to keep or to remove it. But in the end, the Governing Council, given the fact that we can't yet say that we are there with a self-sustained inflation rate, preferred to keep this option in the language. So we will continue to look through changes in HICP inflation to the extent that they are transient and without implication for medium-term outlook for price stability. Thank you.
Stefano?
Okay, what do you take out of this, Yohay? He's down a bit hawkish in this last answer.
Two questions.
Yeah, about rates. I mean, we saw Eurodollar hardly moving for a long time, and 20 minutes in, 25 minutes now, we're seeing it rising. Yeah, so basically, like in December last year, March a year ago, we said rates will not rise and will not fall any further. I mentioned that again, but afterwards, he said it's not such a drama. I also don't see it as such a drama. We've seen Eurodollar spiking almost to 106. Oh, well, sorry, 105.88, now falling back.
Yeah.
What do you think?
He had sounded a bit more hawkish maybe than the market was expecting, but actually it did not add much new to the table. And so far we had no comments on tapering, right? No questions on the model.
Yeah, no sense of urgency, but still very accommodative policy is needed. So
yeah,
I think, yeah, throughout the statement, we've seen him saying on one hand, on the other hand, some things are better, some things need improvement, tapping himself. Well, he had a very long list of achievements, And then, but on the other hand, there's still a way to go. We have to keep it sustained. So also here, I see it as there's no sense of urgency to keep this line, but of course we're accommodative. We're not. There's no change in policy. So
yeah, but he said that he brought good news. Good news. The unemployment rate in January was lowest since 2009, and the risk of deflation disappeared. Lending rates for households have decreased. Well, actually, it was not that bad,
Yeah. We talked about having to acknowledge reality.
Yeah.
But to every positive sentence, he added a but something, right? But not that much.
Because he doesn't want the euro to go really up, really high, You have to
indeed.
control the expectations.
Yeah, I do agree with you on that. It's probably wanting to keep the euro rally limited. Anyway, the pair is approaching 600, and if we go above 600, remember, guys, that 635 region that kept the rally for the past 3-4 weeks as being the next probable bullish target if it can go there.
Yeah, I'm looking at 106.40 and 105.20, but
yeah,
so a little bit of action.
Yeah.
Yeah, well, there is a couple of questions here, of course, the level for euro dollar, but also the level for euro pound. If you have any comment on euro pound, of course, the euro crosses.
Well, given that the euro is the star of the moment, and even despite the pound is also advancing a bit, and the euro pound is trading not much action in there going on around 86.90. We have a height around 87. So if the euro dollar keeps rolling, that's the main bullish target for the pair. But keep in mind that there's not going to be much more action or pips in the euro pound because the pound is benefiting from this euro momentum. Okay, so be aware of that. That's the level I'm watching to the upside, probably an advance up to 87.
And what are you taking the Japanese yen? Also, it's just testing up the levels.
Okay, the Japanese yen is weaker right now, so the pair is moving past 121.40, which is a major resistance area. We are 15 pips above it, not yet confirming a break of the level because it's there, but seems quite positive. We have some intraday highs around 21.80. So if a pair manages to advance up to that level, we probably see an extension up to 22.50 or so. That's the level I'm looking right now. If, however, it's multiple gains above 51.40, then it will probably return to 20.90 or so. We are seeing a bit of a movement now with Draghi, but still, the market still needs to settle, right? Next question can turn the euro dollar lower.
Yeah, I see. And Yohay, your opinion on what the trader should focus now? What pair?
Well, I think for the non-farm payrolls, dollar yen is the most important one. Usually it best reflects the mood, the general mood in the dollar. That's the main event tomorrow. Non-farm payrolls, I think we still, press conference hasn't ended, and we'll have a few more hours of impact of what Draghi said, some analysis, a few more moves, but in a matter of a few hours, 2-3 hours, I believe that the focus will fully shift to the non-farm payrolls.
Yeah.
And we're expecting a higher non-farm payroll than expected, right?
Yeah, we anticipated non-farm payrolls to beat expectations, given the strong ADP report we have yesterday.
Yeah, also the ISM numbers last week, manufacturing, non-manufacturing, were above expectations. And again, the Fed told us that they would have to see a disaster not to raise rates, so probably they're not expecting a disaster.
Okay, well, we have a question from MCIT FXX81 about the dollar, Canadian dollar. If you may want to do an analysis on that, Valeria. And
Well,
then,
CAD is trading purely on oil prices, right? It has plummeted alongside with oil. And now that oil bounced a bit from that low in the 48 something region, 48.80, if I'm not wrong today, the CAD is seeing a bit of a life. I didn't check how Canadian data came out. It seems good, positive. But anyway, there are no chances that the pair can change course, this bullish trend it's developing on, unless oil reverses course, right? We need to see oil resurgent above 50 and recovering the last ground to see the dollar CAD turning back south. So beware of further gains if oil continues falling.
okay, thank you. And your take on that, Yohay?
Yeah, as Valeria said, now it's all about oil prices. After quite a boring period, oil prices plunged yesterday, extended the falls today. Tomorrow there's a double jobs report, also jobs report in Canada. So it'll be quite messy for dollar CAD. I would say stay away from the pair until the dust settles. Tomorrow at 1:30 GMT, we have the NFP and the Canadian jobs report. But I think oil sort of now took center stage with moving the Canadian dollar. So lots of action in CAD. I think we'll get a clearer picture tomorrow afternoon.
Okay, thank you, Yohay. And any opinion on the Dixie, Valeria?
I didn't saw it today. Let me see. Okay, nothing. Actually, not much to say. They are mid-range for the week. I guess we're going to need to see what happens tomorrow with payrolls in there, but it's looking bullish for me because it's developing within an ascendant channel in the daily charts, so beware of that. We have a top around 102.26, which is the high we see late last week. So that's the level I'm watching to the upside. And short term, 101.70, we have a couple of daily highs and daily lows. So 101.70, which we are quite close right now, is the main support. Below that, we can see dollar easing further today.
Okay, thank you. A last check. Yeah, go ahead.
Sorry, it's saying that the euro is going to 600 right now.
Yeah, I was about to ask about the euro dollar, if you don't mind. What are the levels to watch and your approach and your short-term forecast on that?
Yeah, well, as I said, it can go past 600 right now, but we have a major resistance in the 630 region. We have, meeting selling interest between 630 and 640 for the past 3-4 weeks. So that's the first resistance. If the pair breaks above it, it will probably trigger some stops and therefore continue rallying. 660 comes next in the short term ahead of 710, right? And to the downside, 560 is my first support and 520 is the next one. Seems unlikely we will go below 520 today. There we go, breaking to 600.
Oh, impressive. Okay, guys, I think we can make a wrap-up time. If you don't mind, Yohay, today to start.
Yeah.
What's happened today, what's going on in the market, and what Draghi delivers?
Well, I was already almost about to fall asleep. Well, exaggerating, but it was almost half an hour of nothing. I mean, Draghi kept it extremely balanced on one hand. On the other hand, growth is rising, inflation is rising. He had a very long list of achievements. We created 4 million jobs. On the other hand, we need more accommodative policy to sustain inflation. Everything was extremely balanced. Then one question about using all instruments. And Draghi said, yeah, it's not so dramatic, but we decided to remove it because we don't want to convey a sense of urgency. And now markets are a bit reacting to that, and we're about 50 pips higher. We could go a bit more to the upside. I think that the reaction is a bit exaggerated, even though I'm very happy to see a reaction. And I think he wanted to keep things balanced, and by stating that they're ready to increase if needed, which is repeating and what he said in the past, and by saying that monetary policy remains accommodative, I don't see his statement as very hawkish. In any case, I think French elections and of course tomorrow's non-farm payrolls are bigger events.
It was a bit more hawkish than expected, I guess.
Yeah.
Adding to what Yohay said, I do agree that it was a quite balanced statement, a bit of positiveness, but not that much. He doesn't want a stronger euro. And I also do agree that we are not going to see much more action today there because of payrolls tomorrow and hopes for the Fed and upcoming elections in Europe. So quite restricted movements across the board these days. Anyway, I believe that he tried to sound less optimistic than what he really is. And well, I believe that the concerns on inflation are key. As long as inflation remains subdued, he remarked about not watching headline inflation, but core inflation, which was what Yohay had said at the beginning of this coverage. So that's the key these days, right? Core inflation. And there were no comments about tapering, so a bit of a overreaction, yeah, indeed. But well, there we are. If you take a look at the market, what's surprising me a bit right now is that dollar yen also rose with the news, right? With dollar stronger against the yen. But for the rest of the market, it's quite of a dollar weakness today, okay?
Okay, guys, thank you very much for your time today. Some comments here in the chat that Karen say thank you very much, and you guys, you and Yohay are the gold standard in FXStreet. Saki say love you guys. Disareta, thank you. Mcita, thank you. So guys, thank you very much for coming today. It's been a pleasure to be with us, with you guys. And also see you tomorrow for Northern Payroll, and see you in the next week for your shows.
Okay,
thank you very much.
Not tomorrow. Tomorrow it's Wayne.
Yeah, tomorrow is Wayne. Yeah, but the audience, just let them know that we will have Northern Payroll.
Thanks everyone for the nice comments, and as always, a pleasure to be with you guys covering the market. It's really entertaining. Hope we can work with more material on the upcoming meetings. Okay, thank you and bye-bye.
Thank you.
Bye. Thank you, Yohay. See you next time. Okay, guys, so now it's time for Phil Carr. Is just refresh your browser and you will get the signal with Phil Carr. Phil Carr is a commodities guy. He will analyze the market on the commodities view with oil, gold, and silver. It's worth it to see that. Now, Phil Carr, and tomorrow, Northern Payrolls, time with Wayne McDonald for a 3-hour show. Impressive. You will not want to miss it. Okay? Bye-bye. Stay safe. See you tomorrow.